Retiring at 40 creates a strange problem. You might have plenty of money on paper, but some of the biggest accounts may not feel easy to use for almost 20 years. That does not mean the money is worthless. It means the timing matters. The question is not simply, how big is the retirement account? The question is, what pays the years before those dollars are easy, tax-aware, and emotionally comfortable to use? If you retire near 55, account access questions may feel close. If you retire at 40, they can feel far away. The household may have a large retirement balance and still need a separate bridge for the first stage of life. That bridge might come from taxable investments, cash, Roth basis, planned income, a business sale, real estate, or part-time work. The details depend on the household, and every exception has its own fine print. The important point is simpler. The bridge before easier account access needs its own design. But the high-level idea is simple. Money with access friction can be powerful later while still failing to solve month one. The first bridge is the money that gets you from quitting to the first easier access point. For a 40-year-old, that bridge can be long. It has to survive ordinary spending, healthcare, taxes, inflation, and market swings. If the bridge is strong, the retirement account can keep doing its later job. If the bridge is weak, the household may feel forced into awkward choices. Sell at a bad time, create unexpected taxes, take on work they hoped to leave, or use rules they do not fully understand. A bridge is not glamorous, but it is what makes early retirement feel real. There are rules and strategies that can sometimes help early retirees access money. But the mistake is treating a rule as the whole plan. A rule can be useful and still have constraints. It can solve one problem and create another. It can require precision. It can change the tax picture. So before getting excited about any one technique, ask a simpler question. If no special rule existed, how many years could the household comfortably fund? That answer tells you how much pressure is being placed on the rules. The less pressure, the safer the conversation becomes. The access gap also interacts with taxes and healthcare. Which account you use can change taxable income. Taxable income can affect other planning areas. Roth conversions may be useful in some situations. Selling assets may create gains. Working part-time may create income and health insurance options. This is where the plan becomes personal quickly. The main point is not to solve the tax code. The main point is that the bridge years are not empty space. They are the years where the household decides what income appears on the tax return and what assets stay invested for later. A useful stress test is to cover the retirement account folder with a piece of paper. For a moment, pretend it cannot help during the first stage. Now ask what pays the first 5 years. What pays the next 5? What happens if markets fall? What happens if healthcare is more expensive? What if a child, parent, or house needs money? Then uncover the retirement account and decide what job it should play later. This exercise is not pessimistic. It protects the retirement account from being assigned too many jobs too early. If the bridge is too thin, the answer is not automatically, keep working forever. It may mean building more taxable flexibility. It may mean reducing fixed spending. It may mean planning a sabbatical before full retirement. It may mean part-time income. It may mean delaying by a smaller number of years with a specific bridge target. The important part is precision. One more year is more useful when it is solving a named bridge problem. It is less useful when it is just adding money to a pile that still has no timing map. Picture a household retiring at 40 with a large retirement balance and a smaller taxable bridge. The account statement looks reassuring until the couple asks what actually pays the next decade. Now the big later account is still valuable, But the first bridge has to stand on its own long enough for later tools to become useful. The cleanest way to think about this is to name the gap before naming the rule. If you retire at 40, there may be almost 20 years before some familiar retirement account access points become easy or normal. That gap is the problem. The exact tools can come later. Some households may use taxable investments. Some may use cash reserves. Some may consider conversion ladders, 72T, taxable sales, part-time income, real estate income, or other bridges after professional review. But before any of those details matter, the household needs the plain answer. What pays life before the locked money becomes easier to use? Retirement account rules deserve respect because getting them wrong can be expensive, but a video can become too technical too quickly. The first layer is not the rule manual. The first layer is the bridge. How many years need funding? Which dollars are available without creating a bad tax or penalty problem? Which dollars should probably stay untouched until later? Once those answers are clear, then the household can ask a qualified professional about the specific mechanics. That order matters. For an age 40 retiree, one more year can be useful if it shortens or strengthens the bridge. Maybe it adds taxable investments. Maybe it builds cash. Maybe it reduces spending. Maybe it creates a clean plan for stock compensation. Maybe it gives the household time to verify account access rules before relying on them. Those are concrete repairs. But if one more year mostly increases assets that are still hard to access early, the same bridge question may remain. The useful test is simple. Does the year make the pre-access years easier to fund? Before the paycheck stops, the household should be able to say, from 40 to this later access point, life is paid by these dollars. These dollars are governed by rules, so we verify them before depending on them. These dollars are meant for later and should not be forced into the first decade, unless the plan says so. That is the plain version. It will not answer every tax question, but it tells you whether the retirement has a bridge or just a big locked number. The point is not that retiring at 40 is impossible. The point is that retiring at 40 means the standard retirement system is farther away. That distance has to be funded. If the funding bridge is strong, the plan may become much less scary. If the bridge is vague, even a large account balance can feel trapped on the wrong side of the canyon. So start with the gap. Then test the dollars. Then verify the rules. That is a calmer order than trying to memorize every account rule before knowing what job the money has to do. If you retire at 40, do not let a large retirement account fool you into thinking the first bridge is solved. The money with access friction is still real money. It may be powerful later. But the first question is what pays before it becomes easy to use. Once you know that, the account rules become tools instead of a source of panic. A good early retirement plan does not only count the money, it schedules the money. If you are trying to leave work before the account rules make it easy, please subscribe to the channel. I will keep breaking down the bridge years in plain English.